Thank you for being here. Now I speak as an associate in for engagement at BASE. It's great hosting this conference here and having you all here. So I hope that you will enjoy and benefit from the day. Just to clarify that here today I speak with my role as an academic at BASE and as the co-investigator leading on the maritime operations, digitization and finance part of the hub. And I'm not in any way representing any of the views of the Department for Transport. So, let me begin by, again, repeating the aim of this presentation. I will aim in very simple words in just 14 minutes to explain why examining the economic and financial perspectives of shipping decarbonization is important. So, why do we need to do that? It has been estimated that the cumulative investment needed between 2030 and 2050 to reduce the shipping CO2 emissions in line with the IMO targets will be roughly 1 to 1.4 trillion. So, why this is a problem? First of all, apart from the significant amount of investment, this is a totally new environment for the shipping stakeholders. As you can imagine, shipping companies need to expand, train their operating, chartering, and financing and legal functions to understand and account for those changing regulations. Unfortunately or fortunately for us, the existing academic literature has not really focused on this aspect. So most of the literature has focused on the technological and regulatory changes, but not on the financial aspects. So those dimensions are rather overlooked. Today, ship owners face a trilemma. The first one is, shall I invest in a cheaper but more polluting conventional, let's say, vessel, conventional in terms of technology, less eco-friendly technology? That's the one action. The second one is, would it make sense to invest in a more expensive but eco-friendly vessel? The third one is, do nothing and postpone my decision until there is more clarity about the regulations, but also the technology has evolved. Now, by more eco-friendly, in our context, we mean CO2, reduced CO2 emissions. For example, today, an eco-friendly Cape-size vessel is the largest vessel, as you probably know, in the dry bulk sector. So a Cape-size vessel burns 10 less tons of fuel when sailing compared to the conventional counterpart. The Aframax, that's an oil tanker vessel, burns roughly 8 less tons of fuel per day when sailing. So you see there are significant benefits in terms of sustainability. Now, what we observe here in this graph, we have on the left y-axis the average earnings that a vessel, irrespective of its size or type, earns per day. That's what we call also the Clarkson's in the Clark's index. On the right y-axis, we see the contracting as expressed in terms of DWT million. So that's essentially the order book, the new orders, not the whole order book, but the orders, the new building orders placed in a given month. So if we split this sample, let's say from January 2005, where data start, until 2018, so until April, what was the adoption of the initial IMO strategy on reduction of greenhouse gas emissions from ships, we see a correlation which is 60%. So you would say that there is a positive, moderate to strong correlation between earnings and contracting. And there is evidence, academic evidence, and in practice we know that when the markets are high, ship owners tend to order new vessels. That's both empirical and anecdotal evidence. Now, what happens from April 2018 onwards is we see that this correlation drops from 60% to 22%. So it drops significantly. What is more, if we examine the correlation after the publication of the fourth IMO greenhouse gas study in August 2020, we see that it decreases even further, it becomes negative, but the essence is that from moderately to strongly positively correlated, it becomes essentially uncorrelated. So, what we try to explain in this paper, that is joint work with our postdoctoral researcher at BASE, Ioannis, who is here, and I thank her very much, and also other colleagues from BASE, is to contextualize this technological and regulatory uncertainty and how this can affect the investment decisions or affects the investment decisions of ship owners. So, traditionally, the primary investment risk in shipping had to do with freight rates volatility. It's a very volatile industry, as you all know, and we're talking about assets with values that can exceed, in some cases, $200 million. So, until recent years, ship owners were concerned mostly with the question, when is the right time to order, buy, sell, or scrap a vessel? Second, should it be a new building vessel that I buy or a second-hand vessel? Now, in the last 6 years, let's say, there is also a technological and regulatory risk. So how will the current and forthcoming regulations affect the industry? These regulations, apart from the uncertainty and clarity about the future regulations, we see that they also vary among jurisdictions. So, for example, we now see the EU ETS in place, which is not in place for other countries. Now, then it will depend on the availability and price of the fuel. So, as a ship owner, as an investor, you will be worried about the optimal fuel of the future. Which one is this? What are the required technology and specifications for a newly ordered, purchased, retrofitted vessel to burn that fuel? We also discuss about market-based measures which are related to carbon prices. For example, a carbon levy of $150 per metric ton of CO2 equivalent. Also, there are safety concerns related to alternative fuels. So that's the picture here. Is there underinvestment? So we see in this graph, on the left-hand side, the tanker order book and the dry bulk order book. The right-hand side, we see the age of the two biggest sectors in shipping, so the dry bulk and the tanker sectors. So, if we focus on the blue and the purple lines, we see that the order book is historically low, the levels in the last years. And moreover, what we see is that the age of the fleet has increased significantly, so it's close to 12 or above years for the two sectors. So we observe a relative underinvestment in new building vessels, which apart from sustainability, can have important adverse effects on the mid to long-term supply of the fleet, and in turn on the efficient facilitation of world seaborne trade. So, let's take as an example an eco-friendly and a non-eco-friendly vessel from the ones that are today. Notice that I'm not examining here vessels that burn alternative fuels to vessels that burn fossil fuels or oil. We're just examining the differences between vessels that have eco-friendly engines, so burn less CO2, to vessels that have more advanced engines. So, as you can imagine, from a technological perspective, eco-friendly vessels should trade at a price premium compared to their conventional non-eco counterparts. From an investment perspective, though, so from the ship owners or the financiers' perspective, to be willing to pay for such premium, the eco vessels must generate significantly higher cash flows than the non-eco vessels to justify this price premium. So, from a shipping operation perspective, reduced fuel consumption implies less fuel costs because I burn less fuel, and that's why I emit less CO2. Second, less carbon emissions, so for example, less EU ETS allowance costs. And if and when carbon pricing is in place, it will also mean less carbon taxes paid. So what we have in this graph is, in the blue line, you see the price premium. So what is the price premium? Is the price of the eco-friendly vessel over the price of the non-eco vessel minus 1. So it's the price premium that I will need to pay to acquire an eco-friendly vessel instead of a conventional one. In other words, we find that on average, if I want to buy a Cape-size vessel that is eco-friendly, I will need to pay 23% more than the conventional vessel. So 23%, 1/4 more, let's say. On the other hand, the time charter rates that I will receive for this vessel, the eco-friendly vessel, are only 9% higher than the rates that I would have received if I had invested in a non-eco vessel. So what we see in this graph, and a similar picture is for the Aframax vessels. So what we see in this graph is that according to the long-term cash flows, the time charter rates, this investment is not justified. Moreover, we see that this price premium is time varying. So there are periods, for example, at the beginning of the sample, that the price premium is 31% higher for the eco vessel, while in the second part of the sample, it drops to 15%, still significant, but half than in the first part of the sample. As you can imagine, from a shipping economics perspective, when we're in bad markets, obviously we're in bad markets. Why? Because the demand for vessels is much lower than the supply of vessels. So in that case, you would expect that the price of the eco-friendly vessel is significantly higher than the price of the conventional vessel. On the other hand, when we have prosperous markets, the demand is high for shipping services. The supply is limited in the short run because it takes 2 years, let's say, to build a new vessel. So increased demand for shipping services with a fixed supply drives the prices not only of the eco vessels up, but also of the less eco-friendly vessels up. So we see this volatility in the premium. So what we have established so far through those findings is that the time charter rates, so the long-term cash flows, do not justify this investment. Let's turn to the green finance dimension, because we hear a lot about green finance, we hear a lot about green loans or sustainability linked loans. So if we examine deals with green loans compared to standard loans, so not a sustainability element there, we see that the interest rate for the green loans is only 23 basis points lower. So in that sense, I don't have a significant advantage through green finance to justify this investment. So neither this dimension can explain this premium. So I won't bother you with econometrics and further findings, so I want to wrap it up and contextualize it a bit. So where we are in terms of fueling transition, that's from Clarkson Research, June 2024 report. So you see that the current fleet set to be alternative fuel capable, it doesn't mean that they burn now alternative fuels, is roughly 7% of the total fleet. If we see the right graph, since 2018, there has been a significant increase in the order book regarding alternative fuel capable vessels. So you see that they have increased, and 36%, for example, of the current order book is LNG capable vessels, 9% are methanol capable, and then we have other alternative fuels. So roughly 50% of the current order book is for alternative fuel vessels. But we see that this increase in the order book, if you see the end of the graph there, the last 2 years, the order book has stabilized, so we don't see this rate of increase that we saw in the previous years. So it's relatively stable. Moreover, we see that most orders are for LNG. Okay, LNG is an alternative fuel. It emits less CO2 than the vessels fueled by oil, but still it's not a green fuel, right? And finally, we see that despite the 50% of the order book in alternative fuels, there is still a 50% that is for fossil fuels and oil in particular. And those vessels, if I order my vessel today, and this vessel, let's say, is delivered in 2025 or 2027, it will have an economic life of, on average, 20 years. And this vessel, 50% of the order book, will be burning fossil fuels, in particular oil. And the IMO targets are 2030, 2040, and 2050. But 50% of the fleet now will have a life until then. So that was the first paper. It was submitted recently, fingers crossed. Now some work in progress. What we examine now is whether carbon efficiency, how do we measure carbon efficiency, is the economic output versus carbon emissions, whether it differs by vessel types, by segment, eco-status, and size. Moreover, how does financial strength influence energy efficiency? What are the effects of relevant market-based measures? And the second question, which is important also because it's related to engineering, is what causes shipping energy technology, innovation, and diffusion, and whether recent regulations and knowledge spillover have an impact. So I think I'm on time, hopefully. So thank you.
Thank you.